Hey everyone, Dan here. I am recording on April 7th, about an hour from market close. And the reason that I'm putting the timestamp on this video is because of just what's been going on in the markets and with all the volatility. So really, unless you've been living under a rock, you know that President Trump made the Declaration of Economic Independence last week, and the markets have really been responding since then. So April 3rd and April 4th, so last Thursday, last Friday, have been a pretty big two-day drop. But I have a few stats that I want to offer just to provide some context. We could talk for hours and look at charts and stats, but I really have three. So number one is the two-day drop that we saw when we measure it from the Dow. It was a big drop. It was about 9.3%. But over the last 130 years of the Dow, that doesn't even crack the top 10, worst two-day period. So it's the 20th. So it's the 20th worst two-day period in the history of the Dow. Now, what has happened after every single drop is we've seen recovery. So the S&P 500 is another big index that people are pretty familiar with. So most people know that on average, the S&P returns about 10% per year. I say that a lot. I reference that a lot. I'm sure if you're out there that you've heard that statistic. But what we don't focus on as much is the intra-year drawdown. So on average, the S&P 500 actually drops about 16% per year, even though it still finishes up 10% on average. Now, let me unpack that a little bit. That doesn't mean that every single year it finishes 10 and every single year it drops 16. Some years it finishes higher, some years it finishes lower. Sometimes the drawdown is lower and greater than 16%, and other years it's not as bad. That's the whole point of averages. But when you look at the average drawdown, the point being is the S&P 500 just doesn't go up in a straight line. So it drops on average about 16% per year, but still finishes up 10%. So the point being is we've seen volatility, and oftentimes it's the volatility that allows our equities to actually appreciate. The final statistic is around 5-year time periods, and I'll get into why this is important in a minute. But on average, when you look at just a 5-year rolling period with equities, they're up about 95% of the time. And it's even more favorable for investors if we're up 10 years or 15 years or even beyond. But basically, the longer the time horizon, the greater likelihood that your equities investments will be up. And so in a 5-year time period, on average, from your starting point to 5 years later, your accounts are up 95% of the time. So I have messages really for three different types of clients, three different types of investors. So number one is the accumulators. If you're an accumulator right now, this is actually a gift to you. I think about the Black Friday sales that happen every year and the stampedes that we see of shoppers running in to try to buy their goods. They're not stampeding and rushing into these stores to return their items because they think the value has dropped. I mean, they're seeing sales on the TVs and the computers and the tech and appliances that they've been eyeing for a while, and this is their chance to buy low. And that really is a good parallel if you're an accumulator, if you're an investor, continuing to buy. And if anything, if you have money on the sideline, this might not be the worst time, to deploy that into the equities markets. Group number two, I'll call this my retirement transitioners. So these are my folks that are about 5 years from retirement. So for you, I would still encourage you to invest just like my accumulators. And the reason being is once you retire, we don't just move your investments to cash or to bonds. We still need appreciation. We still want to outpace retirement or outpace inflation over your retirement. So it's still important to be accumulating, but we're also looking at that 5-year window when you start, when you might need to draw money out of your portfolio. So in reviews that we do every year, that's why we talk about that 5-year cushion and do we have the plan for when you do need to start taking money out of the portfolio. So the point being is we plan for this. I think about, you heading on an airplane about to land into, we'll call it retirement island, and we can kind of see it out in the distance. We're not just going to suddenly drop down to land the plane. We're going to slowly lower the altitude over time to make a nice smooth landing. And that's kind of what we're doing with the financial plan to make sure that you have enough cushion as you're about 5 years out from needing money, that we have it built in. And then finally, my true retirees. So those of you, I'm beating this metaphor, this simile to death, I know. But for those of you that have already landed on retirement island, for most of you it's a one-way ticket. You don't have a return ticket back to work. You're there, you're in retirement. But a lot of the truths still hold true for you, where we're always looking out and making sure we have that cushion of safety? Because it's not a matter of, if we experience corrections, or if we experience bear markets, or if we experience recessions. It's a matter of when. And we know that, we experience market corrections about once a year, and we experience bear markets about every 4 to 5, sometimes 6 years. So those are the averages that we're working with. And so when they happen, a lot of times the reason for why they happen are unknown to us. We can't predict it, right? A tariff war, a pandemic, planes hitting the Twin Towers in New York. So these are things that we don't quite expect, but the market activity we see over time, this volatility and the correction, and we're certainly planning for it. So there's really 2 things that we're doing that are where we're being proactive during these times. So number 1 is opportunistic rebalancing. So as the stock values, the equities values are going down, if we have some cushion in the safe side of your portfolio, we're actually selling off some fixed income, some bonds, and maybe buying into stocks when they're on sale. And so when we rebalance the account, rebalancing is just a way to systematically sell high and buy low. So we're certainly doing that, especially in your qualified retirement accounts. For those of you with taxable investment accounts or brokerage accounts or trust accounts, we're looking at opportunities for tax loss harvesting. So this is when there is a drop in value, especially in equities, we may sell that position and purchase something else that's similar. So we're not changing the makeup of the portfolio, but we're capturing those tax losses. And those tax losses can be used to offset your capital gains later in the year. They carry forward into the next year. You can offset your taxable income by a little bit. So $3,000 per year to be precise. So there's things that we're doing that we're very proactive in how we're managing the accounts that we're able to do because of the volatility. Not that we wish this on anybody, but there's certainly some things that we can do to take advantage of this. So I would be remiss if I didn't speak to the emotions behind some of this. And a lot of you know that my background's in psychology as a mental health provider and a psychologist. And so I can empathize with you. I know these are scary times when you see the accounts dropping on paper or on your computer screen or on your phone app. We're wired in a way to feel some panic and some dread around that. But just know that, during times of volatility, the bad investors are the ones that panic and do something, reactive. Good investors hold, but it's the really great investors that see this as an opportunity, to advance their financial plan and their portfolio. So I'm here. If you guys have any questions, feel free to reach out to me. I'm going to be reaching out to many of you along the way just to check in and touch base, but don't hesitate to reach out if you have any questions. All right, thanks.